Now we come to the last part of this topic of this session, that is variance analysis. So I hope you are still having some insights into variance analysis based on the budgeting sessions, because we had discussed a bit about the variance analysis. But now we'll dive in deep and understand it thoroughly. What is variance analysis? Variance analysis is basically the study of the deviations between the actual results and the budgeted results. Or you can say the budgets and the actual result, how the performance of the entity has been in compared to the budgets it had set it for itself, in compared to the benchmark it had set it for itself. Okay, by comparing these two things, you understand where the flaw lies. Is it in the budget setting process? Is the entity setting too high ambitious project, or is it undermining itself too drastically and setting a highly optimistic budget and overachieving the results? Or is it that the entity is setting a highly ambitious targets and missing out the results because the actual reality is highly different? But because of the variance analysis, one thing is for sure, either of the process will be having a few flaws. That's why there is a deviation between the actual results and the budgeted results. Now, what is the importance of variance analysis? First of all, it supplements the efficient budgeting activity. So understand this thing. If you prepare the world-class budget, but if you have not compared it to anything, if you have not compared it to your actual results, if you have not figured out why are the reasons, why is the deviation between the actual results and the budget, what's the use of the world-class efficient budget? Nothing, right? So the variance analysis, it supplements your budgeting activity. Because of the variance analysis, the entity is able to prepare itself, to get itself more better in the budgeting process. If the variance analysis was not there, how will they ever know where does the flaw lies? Nowhere, right? Hence, it supplements the efficient budgeting activity. It acts as a control mechanism. Now, analysis of the large deviations of key items, you can say analysis of the major key items of the company, can give the entity a useful insight as to why is there such a big deviation, and the entity can take proper control in those areas, exercise efficient control in those resource deployments, and achieve a better control mechanisms. Enables to assign the responsibility for deviation. Now, in an organization, there's just not just you as a project manager who's working, right? There'll be multiple departments, there'll be multiple people running across the organization, all working towards a common objective. But what variance analysis is just that it helps the entity to pinpoint who is the real culprit in the overall negative performance, or who is the real beneficiary of the overall positive performance of the entity. Sometimes it happens that because of the efficiency of one, two other inefficient people are being covered up, right? Or also vice versa. Because of the inefficiency of one person, many of the efficient persons are not being able to get the credit, because the overall entity results reflects either a single profit or a loss. But what variance analysis does is that it opens up the various layers. It goes deep beneath every layer and figures out who is the one who is doing a better job, who is the one who is doing a negative job, or you can say a shabby job, and point out to those process or persons and take effective actions with those things to make sure the negatives are turned into positive, and the positive, if possible, are improved more. With this concept in mind, let us look at an example where we're going to study the entire budgeting process and variance analysis together. So let us create the example from scratch over here. Okay, so first let us set up a budget for you. Setting up a budget. Okay, over here we can say ABC company is in the process of setting up its budget for the current year. Important details are the following. It needs 2 units of raw material for 1 finished good. Okay. It needs, let's say, 3 labor hours for producing 1 unit of, okay, the same one, finished good, and it incurs overhead at the rate of $10 per hour of direct labor. Okay, simple and sweet. We'll just keep it simple for the time being. It has opening inventory of let's say 5,000 units. It expects to sell a sale of 15,000 units. Let's go 20,000, right? Units, and intends to maintain a closing inventory of 10,000 units. So based on this information, first of all, we need to figure out what is the number of units the entity intends to produce. Based on that, the entire production budget, material budget, and labor budget will be formed. Okay, so before we go into the deep depth of this example, I wanted to know one thing. Most of the project management projects, are going to be also service type, where the material costs, labor costs, all those won't be involved. But the reason why I'm taking up as this kind of examples is because it gives you an exclusive view into all the various cost and analysis which is possible in terms of budgeting variance analysis. You can just use the piece that is relevant to you. Most of the cases is going to be salary cost, it's going to be marketing cost, and so on. But having this inventory thing in place prepares you for a much higher level, for a complex level of problems compared to where you are presently right now, especially if you're in terms of service projects, right? So let's continue the project over here. So the production number of units to be produced will be equal to how much? The simple formula over here is you already have an opening inventory, you are expecting to sell a particular inventory, and you intend to maintain a closing inventory also. So you need to sell, okay, units to be sold. It's going to be 20,000 units. Add the closing inventory. That's going to be another 10,000 units. So this gives you units needed less the opening inventory, because you already have some units in place. So that gives you your units to be produced. 25,000 units. Now you know what is the amount of inventory, what is the amount of goods you need to produce. Now you can create your entire budget over here. So what we're going to do is standard budget for 25,000 units. Material per unit, rate per unit, quantity needed, rate per unit, and the amount. That is going to be quantity into rate, right? So for materials, we need 2 units of finished goods. Let's say the rate is at $5 per unit, $5. So it's going to be 2 into $5. That's going to be $10. Labor, we need 3 labor hours. Here we can say the rate is somewhere around $4 per labor hour. So that's going to be again 3 multiplied by 4. That's going to be $12 per labor hour per unit cost, right? Overhead, it needs at the rate of per hour of direct labor. Overhead also needs 3 labor hours per unit, right? If you see the sentence over here, incurred overhead at the rate of $10 per hour of direct labor hour. So that means for equal number of labor hours incurred, overhead is also incurred at the same pace. However, the rate is going to be $10, and here it comes to $30. So this is the standard budget for 25 for 1 unit, right? For 1 unit. Now we're going to prepare a flexible budget. A flexible budget is the one which adjusts itself to the actual data. You can say in this case, because we need to produce 25,000 units, we're going to compare this budget to 25,000 units first of all over here. So the flexible budget for 25,000 units. The columns are going to be the same over here. The only difference being that we're going to multiply everything by 25,000 over here. Okay. So the total cost incurred for per unit is $52, and total cost incurred for 25,000 units is going to be $1.3 million. Okay. So that's how you prepare a budget, guys. This was your budget setting activity. Now we're going to see how we compute the variance out of this budget over here. So before that, we need some actual data also. Let's say the entity's actual results for the period are as under. It produced 25,000 units. We're going to be staying same in that. Now we're going to say units produced 1,000 units. Okay. Let's say the materials consumed were 51,000 units instead of 50,000, and the material rate was 4.5 at which they procured. We're going to increase a decimal 4.5, right? For labor, it's incurred, it paid for 74,500 at the rate of again 4.5. Overhead also it becomes the same because that's how it's efficient. The overheads were incurred and it paid overhead at the rate of $10 itself. So overall, you can see over here the entity incurred more compared to the original budgeted cost. So obviously, this will tell that it's a negative variance. Okay, as we said, the overall result is negative, but based on that, you cannot judge that who was the real culprit. Was it the material department? Was it the purchasing manager of the material department or the production line manager who was responsible for the consumption of materials? Was it the labor manager or is it the negotiation was not done at a better rate with them? Who was the real culprits and all? That can be figured out only when we actually dive deep into each and every single variances. Just a second, guys. I just want to come make sure this is reflecting the true scenario. Okay. First, we'll go ahead and compute the material variances. Now, remember this thing in the cost accounting and management accounting, there's a whole session devoted to the material or to the variance analysis, but that's at a very high level. I'm not going to be taking you to that level. I just wanted to give give an introduction to the variance analysis so you're at least aware how you're going to compute it on your own. We're not going to go through any formula. We're just going to try to solve it logically over here. So first we'll see material variances. So quantity consumed, or you can say just simply put it as a quantity variance. What's the standard quantity for 25,000 units? It's supposed to be 25,000 units. That's supposed to be 50,000, right? Less the actual quantity. That's going to be 51,000 units. You multiply this by the budgeted price. Okay. Now you might be wondering why we are taking the budget price instead of the actual price over here. The logic being that the difference in the price variances will be taken care by the price variance which is going to come next. Whenever you're going to compute any variances except for price variance, you always consider the actual price only, budgeted price only, not the actual price. However, in case of price variance, you compute using the actual price. It's going to come up in a while. Have some patience for it. That's it. So your variance is going to be how much? be 1000 negative. That is 5000 unfavorable variance. It's going to be unfavorable. Now we're going to compute the price variance for it now. For the materials, okay? I'm using the same template over here. Kind of makes easy. Now standard price for, okay, standard price for 1 unit, that was supposed to be $5. Actual price, it's gonna be 4.5 multiplied by the budgeted quantity. We're going to take the budgeted quantity because the quantity variance, or you can say the reason why the variance exists because of quantity is already taken care by the quantity variance over here. The budgeted quantity is supposed to be 50,000 units. Okay, so the variance, obviously you can see the fact over here that the purchasing manager did a good job because the product which the company had budgeted for $5, he negotiated it down and bought it for $4.5 over here. So that's a 50 cents of saving for every unit purchased, and that results in a saving of 25,000 units over here. So that's how you compute the price variance over here. We made one mistake over here, which is we're going to use the actual quantity, not the budgeted quantity. Sorry, yeah, that's it. So the reason we use the actual quantity is that because the variance which was existing because of the quantity difference was taken care over here in quantity variance. Now we only need to figure out the price variance over here. Compare the standard price with the actual price and multiply by the actual quantity. That gives you your variance for the price. Now this is going to be a favorable variance because it's a positive figure over here. How do you determine a variance is a positive or a negative? It's simple enough. If the cost is less than standard, or you can say the budgeted cost, it's a favorable. If the cost is more than the budgeted cost, it's a unfavorable variance. There's a double check over here that in the basis of which you validate your variance computation is correct for this material variance. You see, the total material variance over here is going to be expected cost, standard cost minus the actual cost. The cost incurred is more. Actual total cost incurred is less compared to the budgeted cost, hence it's a positive variance of 20,500. But if you see the fact over here, your price variance is 25,500, whereas your quantity variance is a 5,000 negative figure over here. Hence it is a total of 20,500 of positive variance plus this plus the unfavorable one. That gives you your material variance of 20,500, which is exactly over here the difference between the standard material cost and the budget material cost. So as we had discussed in the theoretical part, the good job done by one guy gets overcome or reduced because of the negative work done by the other guy. Over here, the production manager, the flow manager who is responsible for the consumption of materials did a bad job, incurred a negative variance, or you can say expended $5,000 more compared to the price variance, compared to the other manager who did a good job and saved the entity a total of $25,500. So 5,000 spent extra, 25,500 saved extra over here. Netting it off, it comes to a total saving of $20,500 only. So this is how you understand the fact that variance analysis helps you to layer out who is the real culprit, who is the beneficiary to the company, who is doing an efficient job, who is doing a shabby job. So I hope with this thing you have been able to understand the variance analysis. Before leaving up, I just want to give you one more task over here. The same way how we computed the material variance over here, I want you to compute the labor variance and overhead variance and get back to me on what are your answers. Once I get answers from you guys, I will share whether the answers given by you are correct or not. In a way, it's an assignment for you. Do make an effort to complete the assignment, guys. It will be really helpful for you to understand this whole concept of material and this whole concept of budgeting and variance analysis. I'll give you a small hint. The computations are same as we had done over here for material variances. Okay, I'll see you in the next session, guys. Oh, precisely saying, I'll see you when you submit your answers to me, guys. Till then, have a great study time.